Hello, good morning, viewer. Hi, good morning. Thank you for coming back to my channel again, Hocantalk. And today, through this video, I'm going to introduce you a financial arrangement called tax-sparing loan. This is a very special terms. I'm quite sure a lot of the bankers do not know what is this now because this is not a new thing. The use of tax-sparing loan is diminishing, meaning is dropping, and I'll explain why later on. And this video, I will give you all the background about what is tax-sparing loan. I'm quite sure this is the first time you heard about this loan. It's also not taught in your school or whatsoever, so it's always good for your own career development, for your own general knowledge. And again, please do subscribe to my channel if you find that my videos are useful to you, and I really put in effort. You see, sweating all over the place now. It's getting hotter in Singapore, so I'm putting a lot of effort to educate, to give you all the knowledge regarding this. So whether your company is involved in borrowing or finance or whatsoever in your general career, these are knowledge that very useful and conducive to you. Okay. Likewise, the same video will be produced in English and Chinese, and also I'll be using marker and paper to present on the material. Okay, so without further ado, let's start from the first slide. And if you look at the first slide, today's topic is called tax-sparing loan. Tax-sparing loan. This is not a term that you hear every day. You know what is a loan, but what is a tax-sparing loan? In Chinese, it's called 免税贷款. But the Chinese translation 免税贷款 actually simplify a lot of things. There are more things behind this loan. Now, if you look at the second slide, I give you some history about this loan. The history of tax-sparing loan, and before I will come to explain to you what is called a tax-sparing loan. Now, in the 1960s, that's the end of colonial era. So, tax-sparing clause, okay, tax-sparing clause has been included into a lot of double tax agreements signed between two countries. So after the colonial era, a lot of developed country want to help developing country, or they still have the feeling, or they still have a lot of economic ties to the previous colonial economy. So they wanted to extend some help to promote their own industry in that country. So when they sign a double taxation agreement, they will put in a tax-sparing clause to exempt certain tax that cover interest payment and dividend payment. Okay, this is something to do with holding tax, which I'll explain later on. Now, so let's look at the history first. In the 1960s, that's where the beginning of tax-sparing clauses in double tax treaty. So that's where the boom, the whole thing started to develop, because tax-sparing loan is involving cross-border loan, country A and country B, borrow in country A and lender in country B. Okay, so you just remember, tax-sparing loan got to do with cross-border. That's why the tax-sparing clause can be put into use. Now, in the 1970s to 80s, this is the expansion stage of the tax-sparing arrangement globally among lendings, investor and the borrower. Now, in the 1990s, then a lot of developed countries start to reconsider, and in the year 2000, a lot of countries actually do not wanted to renew the tax-sparing clause in their double taxation agreement, or they are less willing to include this clause inside. From 2013 until now, OECD country come up with BEPS, meaning that they actually wanted to standardize the minimum interest rate, not interest rate, tax rate for all the countries, so as to avoid multinational company from shifting their base of operation and the profit through transfer pricing or moving to a country whereby there is no tax or very low tax, to be fair to everybody on playing on globally. Okay, now what is a tax-sparing loan? A tax-sparing loan is a loan that take advantage of the tax-sparing clause in a double taxation agreement. Okay, so I need to explain what is a double tax agreement. Now, a double tax agreement is between two country A and country B. They sign an agreement to make sure that a single taxpayer is not being taxed twice. So if someone paid a tax in a country A, when he moves the balance of the money back to country B, that's where his home country is. Country B, because sign an agreement with country A, country B will not tax the company more than the taxes that the company has paid in country A. So meaning that the taxes paid by the same taxpayer in two countries will be the same, will not be more than what the taxpayer need to pay. So this is to encourage cross-border investment, encourage economic activity development, and also is a form of helping from developed country to developing country, so that to make sure that they promote trade, promote investment amongst cross-border, across cross borders, and then reduce the tax burden of the investor or the lender. That's why tax sparing clause is a statement inside the double tax agreement to waive certain tax, especially on withholding tax, on interest payment and dividend payment, so that to reduce, to ensure that the burden of the tax are not being unnecessarily shouldered by the investor on the lender, so that the investor and the lender can pass on all these benefit across the board to other party involved in the transaction, including the borrower. Okay, so tax sparing loan is nothing more of a loan that take advantage of a cross-border loan or cross-border investment that take advantage of the tax sparing clause, which is an exemption tax clause in a double tax agreement signed between two countries. Okay, if you look at this slide, I put out there country A sign with country B a DTA, double tax agreement, and inside this agreement, if you look through all the tick document, there will be a clause inside called tax sparing clause, meaning that the two countries agreed that certain tax will be exempted or waived, and then the other country will also recognize that this tax is actually waived, but they will still give tax credit to the lenders or the investor involved, so that they pay less tax at the end of the whole game. Now let's go deeper into the tax sparing clause. Now in this case, I created a more complicated slide. If you look at the resident country means the country that the investor or the lender are based in, and the source country is where the money go to, where the lending or where the borrower is based in, so that you can see this is a cross-border financing arrangement, be it as a form of loan or be it as a form of investment. Now in this case, if you look at the red color line, the investor or bank in the resident country, usually a stronger country, they flow the money into the source country and lend it or invest to the borrower. But the borrower need to pay interest back to the investor from the source country to the resident country. So when they pay interest or dividend, you look at the green line, then the source country will have to withhold certain tax. This is called withholding tax. I believe a lot of people are familiar with withholding tax, so I won't go further into this to explain. So when the source country withhold the tax, then either less interest or dividend is paid to the resident country, to the investor or bank, or they will increase the rate of lending so that to compensate for the tax being paid at the source country. So this is number one. Number two, when the amount of tax is being withheld at the source country, the resident country, because they sign a DTA, double tax agreement, they will still continue to tax the investor and the bank on the income, because interest in this case is the income, dividend is the income to the bank or the investor. They will continue to tax them as if they have not paid any tax. So, or make sure that the tax they pay in total is not higher than the highest tax rate among these two countries. So I repeat in very simple term, when the borrower remit interest or dividend to the lender or investor, the source country that the borrower is in have to withhold the tax. Okay. Now, for when there is a tax sparing clause signed in the double tax agreement between these two countries, then the source country will play a part by not charging the withholding tax, meaning they waive the withholding tax. But the resident country will reciprocate to say that, okay, even though you didn't charge, even though the tax wasn't paid, I will still regard that the tax has been paid by the investor or the bankers, and I will charge them lower tax. Okay, so that's where the tax sparing clause come in. The tax sparing clause bring down the financial burden of the borrower and the investor and the banker, and hopefully this saving will be shared among all parties in the transaction to promote trade, to promote investment, to promote economic activities. So I put down here the withholding tax. Resident country gives tax credit for withholding tax that was not paid in source country. Okay, so far clear? Now we move on to the next slide. Now, why do this tax sparing? Why out of nowhere people think of this tax sparing clause in double tax agreement and all this? So basically, the main purpose in the 1960s, in the 1970s, is that the developed country would want to provide assistance to developing country to help them to get more investment, to help them to lower down the cost of borrowing and whatsoever. So, but all these arrangement, basically someone has to bear the cost later, which I'll explain. So you see, for this, the assistance is from a well-to-do country to a less well-to-do country, so that it bring in funding and investment to the developing country, or what we call the source country. And the investor and the bank, they will benefit because with all this tax sparing, they actually either make more money or they can stick with the same kind of return or charge a lower rate because they actually have less tax liability, and pass the saving to the borrower in the developing country. So everybody enjoy a lower cost of operation, or a financial cost, lower financial cost, that will promote more activities. Okay. Now, tax-sparing loan or investment is, if I narrow down from country to lenders, investor, and borrower, you look at this slide. So basically, is a few commercial party, the borrowers and the lenders, invested in two separate country, wanted to borrow money or do investment. Okay, and then they will check the country, the double tax agreement signed between these two countries, whether there is a tax sparing clause inside the double tax agreement. And if there is, they will do all the legal accounting, legal documentation, confirmation letter from the tax authority and all this, and they will ensure that their overall tax burden will be reduced because of this tax sparing loan. And because of the reduction in their tax liability, they might, or usually commercially, they will share this benefit among to the borrower as well. So the borrower actually benefit from a lower cost of funding. That's how this whole thing works, and that's the logic of a tax-bearing loan. Now, so what's the benefit of the tax-bearing loan to the borrower? If the lender and the investor are willing to share all this benefit, if some banker, they are very sticky, some investor, they don't want to share, they take all the benefit themselves, also have, but usually they will come to a midpoint. The borrower will enjoy lower funding costs, because since two countries is willing to step in to waive the tax, so logically the saving in the tax burden should be passed on to all the party involved in the business transaction. So in this case, borrower will usually enjoy a lower cost of funding. Now, the source company, the company whereby the borrower is based, will receive foreign direct investment. There will be a lot of incoming business activity to promote the local economy. Now, what happened to the one that come out in the money, either as a lender or as an investor? They will have higher return because the total cost burden, the tax burden reduced. So borrowers share some benefit, investor and lender can also share some benefit. So they can earn more money. Earn more money meaning that there are more motivation to lend or more motivation to invest. Now let's look at the next slide. How do bankers structure this tax sparing loan? So this depend on the familiarity of double tax agreement between two countries. So if in this case, this is a very practical discussion now. Now if this case, if your company or if you know someone of your friend, the company wanted to do a cross-border borrowing or investment, you can ask a banker, lawyer, or accountant involved to check the double tax agreement between these two countries, whether it contains a tax sparing clause. If it does, then you see, that's why the step one, you check whether there is. So if there is, then you get the banker, the lawyer, the accountant to prepare a loan based to take advantage of this tax sparing clause. Okay, so both parties must be agreeable. So the investor will say, okay, fine, since there's a tax sparing clause in the double tax agreement between our two countries, let's take advantage of it. So the borrower will say, okay, let's go ahead. And then the lawyer, the accountant, and the banker will go through all the legality, get confirmation letter from the respective tax authority, and then sign the loan agreement based on this arrangement. So when the actual interest payment need to be paid, then all the supporting document will waive them from paying tax to the respective tax authority, and because of that, the pricing mechanism in the loan agreement can be adjusted lower to the borrower, and to the investor and lender, they can achieve higher return, because if not, because some of the tax burden of their return has been waived by the country involved. Now, who bears the cost? Someone got to bear the cost, right? Who bears the cost of tax-bearing loan? To be honest, some textbook or some people say the receiving country, meaning the country where the investor and the lender based. I don't think that's correct. Now, the cost of tax-bearing loans are being backed by the tax revenues of both the resident country and the host and the source country, meaning that the tax revenue of these two countries were reduced just to facilitate this tax-bearing loan. Correct? Because in theory, both countries give up some tax, waive some tax so that to promote economic activities. So at the end of the day, who bear the cost? The tax revenue of the two countries involved. Now, for tax-bearing loan, there are also negative consequences. That's the reason why OECD and the recent involvement of the tax arrangement, they actually discourage tax-bearing clauses in double tax agreement. So you can see that the tax-bearing clauses in double tax agreement actually is dropping and dropping and dropping. If you remember the slide that I told you about the historical development, is keep going down. And also a lot of developed countries will start to ask themselves, why should I help the rest? So in this case, a certain country like USA, they never agreed to sign any tax-bearing clause. Like the UK, Australia, they are not renewing any more tax-bearing clause with other countries, because maybe nowadays they have own difficulty in their own economy. They will ask themselves, why should I pass on all this benefit to other country? My country also need income. So need tax revenue. So again, tax-bearing clauses is on the reducing trend, but they are still around. I think if last time it's 100%, right now I think it's 20 to 23% of these clauses still maintained in double tax agreement. And for bankers who are familiar, or for borrowers who are familiar with this, you can always ask your lawyer, your banker, your accountant to check whether tax-bearing loan can be arranged. See, they are still there, but it's lesser, but still there. Okay. So now the negative consequences is, because with this tax sparing thing, all these are tax waiver clauses in double tax agreement between countries. OECD worried that some MMC will shift their operation from a high tax company to a low tax company, and the high tech company will suffer from outflow economic activity. So OECD country actually came out from a lot of meetings, said that they discourage this preferential tax treatment. They want everybody to pay the same tax, so that at the end of the day, there's no tax evasion, tax avoidance, and shifting of the base business model and all this. Now, coming to here, I want to still highlight to you some of the countries that are involved in tax sparing clauses in double tax agreements. So in case you are talking to a borrower from another country, you're talking to investor from another country, do check whether your country and that country has any tax sparing arrangement, because it's there. So if you don't take advantage of it, then you got yourself to be blamed. So this video, I'll teach you everything, so that at least next time when you want to, when you're involved in the cross-border financial arrangement, be it as an investment or as a borrowing, you can always ask the banker's lawyer and accountant to check whether can you all take advantage of the tax sparing clause. Now, in this case, this slide I put down there are still some countries that still have tax sparing clauses. Among them, like UK, Japan, Australia. I mentioned Australia is not renewing. Whenever the clause expires, they're not going to renew the old clause. Netherlands, USA never agreed to put any tax-bearing clause. So the source country, in this case, the receiving country, they also had to sacrifice their tax, like India, China, Vietnam, Indonesia, and Thailand. I just give you some example. Now, the next few slides, I'll give you even further refinement of the example, but I'm going to just go through them very quickly because you can take a screenshot, you can cut and paste if you want to find out more. But just remember, this tax sparing clause still exists in double tax agreement. And if you are involved in cross-border financing arrangement, do check with your banker. So now the next few slides will be quite fast. So as you can see, example of ongoing tax sparing in double tax agreement, as in New Zealand, still have agreement with China, India, Malaysia, Singapore, Fiji, Republic of Korea. Now, Singapore has still have tax sparing clause in the treaty with India, Indonesia, Malaysia, Thailand, Vietnam, and China. And India has between Singapore, Mauritius, Malaysia, Indonesia, Philippines, and Thailand. I actually put short form because I'm running out of space. Now, if you look at Malaysia, Malaysia still have tax sparing clause signed with UK, Japan, Australia, Singapore, New Zealand. And if you look at Philippines, they have with Japan, Australia, Canada, UK, and Germany. And if you look at Thailand, they have with Japan, Australia, Germany, France, and UK. And the last slide, Brazil, they have with Germany, France, Spain, and Belgium. Okay, so today this video is coming to an end now. I hope my video introduced to you what is called a tax sparing loan or tax sparing financial arrangement. So when someone mentioned this term to you, you will not be ignorant about this, and you will look good because you have all this knowledge. And I'm very sure this term tax sparing loan or credit or whatsoever is not taught in the school. It's a very specialized area of financing arrangement involving cross-border tax agreement between two countries. Okay, so I hope you benefit from my video. And do subscribe to my video, and do circulate my video to all your friends so that they can subscribe also. I need 1,000 subscribers so that my effort can earn some pocket money for these 60 years old retired bankers from Singapore to earn some pocket money. Okay, so thank you. See you in the next video. Thank you very much. And again, if you need Chinese one, I will produce another video using Chinese presented in Chinese. Okay, see you. Bye bye.